This market is obviously a little bit sensitive. You know, I don't think the story is a whole lot of news, but overall, what have you made in terms of just kind of analyzing and assessing the resilience of this market since the last time we spoke?
I'm surprised by it. The S&P 500 is currently trading at just over 20 times earnings. To me, that seems overvalued, but there's clearly momentum here. I think most people feel like the bad news is behind us, as we expect that most of the worst economic into the stock market. And so subsequently, there seems to be momentum.
Okay, I just want to make sure, Shana, we're having a little bit of trouble with your connection hearing you, but I'm just going to give you another question here to make sure that we still got you. Let's talk about some of the ways that you're looking at this market from an investment perspective. I got a list of ETFs. Some of them we've talked about before. Some of them I think are worth revisiting. One that I think is pretty interesting is the idea of fixed income and what role that plays now that we've heard the Fed just repeatedly say they're going to find new tools in the toolbox. How has that changed the way you look at bonds in your portfolio?
We've certainly upgraded our bond exposure. So LQD is one that we've been using and we've increased our exposure to, which is the iShares iBox investment grade bond. We've reduced our high yield exposure. I just think with all of the economic turmoil that's going on, and with all the pressure these companies are under, high yield is just not a place I want to be right now. And overall, we've actually reduced some of our fixed income exposure in favor of liquid alternatives, which I know you and I have spoke about a ton, because we think that that's a better hedge against a downturn in equities than fixed income right now. Because of what the Fed has done, there's a lot of downside in fixed income, in my opinion.
Now, what do you mean by that? Does that mean that it's not going to provide the same type of hedge in a high correlation type sell-off event that we saw in March? Is it that just the returns aren't going to be as good? What do you mean by that, Shana?
So just think about the basics of fixed income, right? So if interest rates are at zero and they can't, and the Fed, Chairman Powell had says he has no intention of going negative. So if that is what you're looking at for fixed income, you have to wonder, where's your upside, right? Because if rates go up at all in any way, that's bad for fixed income. You need rates to be low and going lower for fixed income to outperform. Now, I'm not saying they won't provide a hedge to equities. I just don't think there will be as strong a hedge as they have been in the past. And so that's why we're spending more time focusing on liquid alternatives as a way to hedge out some of the risk of equities and overall risk in our portfolios from both equities and fixed income.
Shana, this is pretty interesting that when we have this period where the Fed is doing so much that it seems like, and I'm with you, it seems from the price action, just observing the way the momentum has slowed in Treasuries specifically, that this really is a trade that's been tied to incrementally lower rates and the almost guarantee that the Fed would keep cutting. So if now Powell's done cutting, he can still be buying a lot of bonds, but apparently it may not be enough for further gains. What about the argument that there's demographic trends and that there's still going to be tons of ripple effects from this COVID situation? Is that not as important to deeper cuts on the interest rate front?
It's not that I don't think it's important. It's that if the Fed has already said that they're not going to go negative, even if they use other tools, more QE, more buying of treasuries in the market, it still makes it hard for fixed income to have a lot of upside. It just is. Now, there are people that are looking for income, absolutely. But I just don't think that fixed income can provide the kind of hedge it has in the past because there's really nowhere for it to go from zero.
Yeah. So, okay, I want to now tie this into the stock market because when we look at the way treasuries have been tied to the market, what does that mean? And if you've been watching the relationship between BTAL treasuries, because we've been talking about this a while, do you think that they're going to be tied to lower rates? Yesterday, this fund got hit pretty hard as treasuries got hit. It seems like they're tied to the hip or close. I mean, how does this fit into the fund as a stock holding if it trades like bonds? Because I know there's a lot of people that have stocks that trade like bonds.
Right. So you mentioned it earlier on in the show, but you talked about how there's a connection between treasuries and the risk-on, risk-off trade. So when risk is off, obviously treasuries underperform, and when risk is on, the opposite. BTAL is a low beta fund, so it really needs low beta stocks to outperform high beta stocks. And if you look at today, the fund has done poorly, but if you look at low vol and quality in general, the two things that work and that fund has a lot of exposure to, they too have underperformed. And again, that gets back to that risk-on, risk-off trade and that connection to treasuries.
So we're still basically kind of assessing what the risk off and risk on characteristics of some of these assets are after the crisis, this COVID crisis and crash. Do you think some of these relationships have changed? Like, I've been trying to figure out the gold one, and I don't really know. Some days it's up with risk, some days it's down with risk. Is hedging difficult right now as we try and put the pieces back together?
I think it is. As you mentioned, some of those traditional relationships to the risk-on, risk-off trade have kind of broken down a little. And again, that has to do with, I think, the Treasury market not having a lot of room to move at zero interest rates. So it is a little bit harder to hedge, but it's not impossible. These products still provide better risk-adjusted returns. It can still improve the risk profile of a portfolio and allow you to take the risk in equities, which right now is not a bad thing, because if you look, the stock market continues to go up. We have had volatility, we have had some down days, but I think the worst is behind us. There's clearly momentum in equities. I don't think that that's going away. And so subsequently, being able to handle some of the volatility in the market by taking in these types of products, these liquid alternative products, whether it be BTAL, which we've talked about a ton, but there are others. We're using the Counterpoint Tactical Income Fund, which I consider a liquid alt. It's more of a fixed income technical trading fund. But these types of funds do provide some great risk-adjusted return and allow us to maybe stay equal weight or slightly overweight in equities, even though we're not entirely comfortable with that because the market is clearly overvalued at 20 times earnings. But you can't fight momentum, and in a lot of ways, you kind of have to think about what's the best way to manage risk in your portfolio. And I would argue that fixed income has limitations right now. So you have to be creative, and that's the Fed's being creative. We're being creative by taking these other types of funds that offer that risk benefit in place of fixed income.
Yeah, all right.